my thesis on the bust, and I put it in a formulaic equation sometimes just to make it easy, but it's 300 trillion in global debt, combined with quadrillions in notional value of derivatives, means we have leverage, massive leverage. You add to that a pandemic that has caused a very fragile economy. So yes, we've had statistically an amazing rebound from what happened in March 22 or second quarter of 2020 or second quarter of 2020 in terms of the shutdown of the economy around the world. But what underneath the surface, we still have a lot of fragility that came about because of what COVID has done. So there's a lot, that the statistics don't really bring out when you see, home purchases are strong, but there's no inventory. We had issues with commodity prices, so builders stopped building. You've got an auto industry that looks okay, but they probably fell short 3 million units last year because they didn't have chips to build the cars to satisfy the demand. So you've got those kind of issues. Then on the other side, you've got people who haven't paid their rent for 2 years, landlords who haven't received their rent payments for 2 years, student loans that haven't been paid because the government basically put a moratorium on. You've got so many things out there, and you've got a lot of people pulling out of the workforce, particularly baby boomers, who are saying, I'm not working anymore. This is too risky. I've got enough to be able to stay on the sidelines, to retire. Or young people who say, gee, the government's giving me these, nice payments. I'm just going to stay out of work until I use them up. So you've got labor issues. There's just so many things out there that are not normal. And so there's what I call fragility. So you got massive leverage plus fragility, meaning that, and by the way, that fragility comes into the picture because it means that when things do turn south, that fragility can exacerbate the downturn or speed it up. So those are factors that we haven't had in previous downturns. And then I just think, if the Fed if inflation continues, and I do think inflation is going to continue up, the Fed is going to ultimately have to crank things down. And I just think we're going to find, as we've seen of late with the markets, that the economy responds to tightening in a more exaggerated way, meaning it doesn't take a lot of tightening because of those other things I discussed, leverage and fragility. It doesn't take rates having to go. You don't have to have necessarily an inverted yield curve. You don't necessarily have to have the Fed funds rate go up 400 basis points, nothing like that. So I do think that we'll see what I call a fast and steep unwind come as a result of what wouldn't normally be seen as a policy mistake, but will be, because the Fed won't realize it until it's too late. Leads and lags mean that they won't know that they've gone too far. So that's still my guess, is that the Fed will be, as they always are, the main culprit in triggering a downturn. And just because of leverage, a normal downturn turns into something much worse. But, in terms of exact timing and all that, I think we got to get through the melt up before we can really worry about, is it, I have been saying, and I continue to say, I think the bust starts in the second half of this year, meaning bust being an economic downturn. But could it stretch where it doesn't happen as soon because the melt up, push things out a bit? Sure. But at this point, my simplistic timing is melt up first half, bust sometime second half.
Right. Yeah. The bust is definitely a big call, because you're calling like 80%, right, from the market peaks.
Well, keep in mind, bust means economic downturn. So bear market, yes, I'm calling for an 80% bear market that accompanies the bust. But people use bust interchangeably with 80%, my 80% call. the bust is the economy, and that's why you'll get the 80% down in the market. But the market will lead the bust. So, if you let's say you get a top in the market, you get to my 6,000 S&P and you top out in the second quarter, meaning you might see the highs in April, but it might take a month or two to kind of retest, or go down and then retest or whatever. And then let's say the bear market starts closer to later in the second quarter or closer to mid-year. You're probably talking about the bust then being a fourth quarter event at the earliest, because the market leads. If we top out sooner and we go straight down, the bust could start in the third quarter. So who knows? But yeah, 80% bear market is a big call. We haven't had anything like that in the post-World War II era. We had a 90% bear market in the 29 to 32 market, 1929. So it's a big call, but that's my work says that's potential. Could it fall short of that? Sure, but I just think we've had, as I call it, a 39-year secular bull market, where you look how far this thing has come from 1982, and understand it's been driven by, we've created such excesses and imbalances out there that it won't surprise me when everybody's pushing buttons trying to get out. That's the other thing we have is with derivatives and with ETFs, et cetera. It's a lot simpler. You don't have to go through a portfolio of stocks now and say, which ones do I like? Which ones don't I like? Which ones am I selling? Which ones am I keeping? People just say, I want out of the market, and basically sell an ETF, an S&P contract or whatever. You could have waves of that pushing markets down in size, in amounts that we haven't seen in previous bear markets, in daily amounts.
Right. Just to add to that bear market, because typically bear markets, the length of time are usually a lot shorter than bull market rallies, right?
Correct.
So
yes.
During this bear market drawdown, do you post the economic bust, do you believe this bear market will last significantly longer, or would it still follow the typical length of time for bear market?
Yeah, I have said that I would not be surprised if the bear, peak to trough is shorter than the 2008-9 bear market. And in fact, I think the bulk of the bear market could happen faster than the bulk of that one, which the biggest part of that bear market was October of 2008 to March of 2009, right? This could happen at least that fast. So that doesn't mean the whole thing is in 6 months' time, but it could happen, that the bulk of it is in that. Now, I don't think it's going to be a straight down. I think you'll have multiple legs to it. But my guess is, because of the leverage, because of the imbalances, you're probably looking at something that's going to happen faster than normal. And not be dragged out by it for a couple of years. I think most of the bear market's contained in a year, and probably less than a year. We have 250 trillion in global debt, and we can't wrap our head around that. I mean, what is that? We talk about trillions like we used to talk about millions, and yet it's a real number, and it's a number that is just out of anybody's ability to manage. And then you talk about quadrillions and notional value derivatives. So those are huge numbers. In just the time since the the March 2020 swoon to now, that 250 is now 300 trillion, and so 50 trillion has been added to global debt in 2 years, in less than 2 years' time. We're just we're seeing geometric leaps in things that are already way out of sight. So we can't, words just don't do justice to what I think's coming. When we say we have leverage, massive leverage, those are just words. But I think when it starts happening, it becomes reality, and it's going to just speed everything up. We saw a little bit of that in March of 2020. Look how we saw a 35% drop in the S&P in 3 weeks' time. That's what I mean. Leverage speeds everything up and makes it worse.